all of that happening at once, now we actually have real inflation. And so mortgage rates go up because bond prices fall, right? So there's a seesaw between bond prices and interest rates, and the mortgage rates are tied to the 10-year Treasury bond. And so inflation causes that to go up because investors are basically saying, if inflation is more than what I can get paid for the bond, why should I hold the bond? So the bonds get sold, the prices go down, the yields go up. And so I just think we're in a different type of period than we were before. And I'm not sure if I answered your question.
You're looking at the old dude going, hey, do you remember what you asked? I'm like, no.
Yeah, whatever the question was, I answered.
I think it was a really good answer to whatever I asked you.
Welcome to the Uncensored Real Estate Podcast, where nothing is off limits. If you're interested in buying, selling, or investing in real estate, and you want to learn some of the insider secrets and uncensored truths from the true professionals in and around real estate, you've come to the right place. Now, let's buckle up for the uncensored truth about real estate and join your host, Brian Cardenas.
Welcome to the Real Estate Uncensored Podcast, where nothing is off limits, and we're going to go a little different direction here today. Normally we have real estate professionals on here to help shed some light on the real estate industry and things that are going on related to real estate. But today we decided to pull somebody off the street and talk to the everyday guy off the street. His name is Dale Shafer. He's with Life Moves Wealth Management. And he might be a knowledgeable financial advisor as well in his part-time duties. So we figured we'll bring him on because lots of what we're hearing about, even in the real estate space, has so much to do with the economy and finances and things like that. Everybody's hearing about recession, inflation, interest rate, gas prices. And so who better than a financial advisor to talk to kind of gain some insight on that stuff. So just first want to say thank you, Dale, for coming on the show today.
Yeah, thank you, Brian. It's nice to be here. Appreciate the invite.
Absolutely. So let's go ahead and just start out the conversation. Pick something. I mean, I know there's a lot that people don't understand about the economy, but pick something that's real topical right now that people are hearing a lot about that you feel like they probably don't understand very well, even if you're the president of the United States, but they should know about.
Yeah, I mean, I think the biggest and probably most topical thing right now is inflation and what happens during inflationary periods, what causes them, how do you get out of them, how do you prevent them from becoming worse? And there's a lot of things at play. I mean, some of that is, policy from the Federal Reserve. Some of it is policy initiatives from our elected officials, and some of it is just what you and I and everyone out there does in the local economy, and all of that kind of gets spun up into this big thing that just gets more complex as you peel the layers back. So
everybody knows that there's inflation. What are the things that are most impacted to the common person when we're in a period of inflation like we are?
Well, I mean, the biggest thing, right now, I'm assuming you put gas in your car at some point in the past week or two, yes. Right? I'm assuming you've been to the grocery store or to a restaurant or something like that. And so where we tend to feel it is in the things that we do every day just to kind of go through our basic life. So, buying groceries, we're paying more money for that now. Going to the gas pump to go do things around our community, we're paying more for that now. In a lot of markets around the country, we're seeing that in home prices and rent prices and things like that. So inflation drives a lot of things up, and it's not just the more expensive things that are what we would call discretionary spending. It really is in kind of our core spending, the things we have to do. We're simply paying more.
Okay, so I think the thing that a lot of people are experiencing, like you mentioned, is their everyday stuff. But related to real estate, they're seeing home prices having just skyrocketed over the last couple of years. Is that related to inflation? Is it part of the causing of inflation? Like, how does real estate fit into that inflation puzzle?
Yeah, well, in this most recent, the past 2 years, kind of, we've had everything going crazy. We had real estate going crazy. We had rent prices going crazy. We had the stock market going crazy. We had crypto. that kind of came out of nowhere and went nuts. And so there's been a lot of drivers. I think a lot of what we saw over the past 2 years when we were forced to kind of stay at home, one of two things happened. You either said, I don't like that kitchen and I just got a stimulus check, so I'm going to, do some upgrades or get a new dishwasher or whatever you're going to do. Or you're going to say, I don't like that wall or that bathroom or that wall. Let's sell this place because, we can and we have equity because we've been a good consumer. We paid down our debt. And going into the pandemic, the consumer's balance sheet was way healthier than it was in 2006 and 2007. So we didn't have as much debt that we were carrying, certainly not as much mortgage debt as we did going into the great financial crisis. So the consumer had some wiggle room. So they could sell their house, they had equity, and then they could go do something else. And so that just caused this, chain of events. And so then everything starts ticking up. In this market, here in Phoenix, I don't know how local, on this show you normally talk, but in this market, we had a lot of money coming in from other states because there's a lot of equity. And as the home prices, supply and demand, as the supply shrank, the demand increased, the home prices went up. We had people able to sell and, walk away with several $100,000 or $1 million or more in equity in their home. And they come into a market where, the home prices are better. I mean, you can get a 1,500 square foot house with a postage stamp backyard in San Jose, California for about $2 million when you can come to Arcadia and get the same thing for $400,000 or $500,000, right? So that's a much better deal. And so we saw a lot of that happening, and that of course drove up the prices because then it became a bidding war. And as you know, with what you do, people were just cash. And so then people trying to get a mortgage couldn't get in. And so you're doing 12 and 13 and 14 offers on different homes. And so it just was a mess as far as real estate's concerned. And now what we're seeing with interest rates going up, which that's a good thing that people really don't understand, is when the Fed does this, it doesn't necessarily do this over here to borrowing rates. But nevertheless, we're seeing borrowing rates increase. So we're probably going to enter a period where home prices just kind of flatten for a while because there isn't going to be as much activity. You're not going to have a lot of people rushing out to buy houses when in 30-year interest rates 5 or 6%, even though those rates might be considered kind of normal, right? In a long-term sense, we've had rates in the 2s and 3s for a long time. And so I think the consumer behavior will adjust, and that's all kind of the downstream effects of inflation.
So I have a theory about that. You tell me if you think I'm nuts or if I'm on target. I kind of feel like, through, lots of different cycles that I've witnessed in real estate and mortgage, we'll have interest rates go up, interest rates go down. And I feel like what I tend to see is when we have a rapid increase in rates, like we've never seen it as fast as it's been these last few months, but right. There's been other times where we've seen a pretty, good tick up in rates, and it starts to catch, the attention of the media, which gets into people's thought processes. And it takes a couple of months, 2-3 months, for people to sort of react to that. I know kind of what I'm seeing is I didn't see an immediate slowdown. People were just like getting a little bit surprised by it. And then after a few months, then people start to think, okay, well, maybe I shouldn't go buy. Like the people that were already in it, most of the time they kind of stayed in it because they had a reason for moving. But then the people that didn't have a reason immediately, they start to react and go, okay, well, maybe I shouldn't do this right now. Maybe we should wait a little bit. Then it starts to slow down. And then it feels like, I don't know what the time frame is, but there's a period of months where people just start to see things stabilize and level out, and they go, okay, I guess this is where it's at. And then they start hearing from all of us and reminding them that, hey, that 2-3% interest rate environment, that was the anomaly. That was not the norm. And there was this little thing called COVID that caused it. And when you realize that that's what the circumstances were that caused that low interest rate environment, and now we're actually in a more normal interest rate environment, then it comes back to, okay, I guess this is where we're at. Now let's go back to the behavior we were probably going to be doing anyway. And then things start to normalize and behaviors start to go back to where they were before, all the chaos started to happen.
I remember, so go back, 2004, 2005, 2006, and a good interest rate on a 30-year fixed, a paper mortgage was probably 5.25, 5.5, something like that, right?
Yeah.
There were some subprime loans where you could do really interesting things, and you could tip down into the high 4s, but somewhere in the 5s was a really good interest rate.
Yeah.
We went through the great financial crisis. The Fed took rates down to 0. Now, let me just real quick, when the Fed does that, it doesn't directly correlate to the mortgage rate, because what the Fed's doing is setting a range that banks can charge each other to meet their overnight reserve requirements, which means that eventually the banks will either lend more money out because they don't have to pay as much to have the reserve requirement, or they'll lend less money because it costs them more to not have cash on hand. So we went through the great financial crisis. We had rates at 0 for basically from early 2009 until December of 2015. The Fed wanted to get the economy normalized. The consumer went ahead of the Fed's targets. And in my opinion, the Fed waited too long to raise rates in that cycle. In my opinion, they've waited too long to raise rates in this cycle. What's different this time, right? And it's always different this time, right? But what is different this time is that the Fed tried for almost 10 years to get inflation to peak above 2% and couldn't get it done. We go through COVID, we put a lot of money into the economy at the same time that we all have to stay home, at the same time that factories are closed, at the same time that we're buying stuff online because we've got nothing else to do, and the goods can't be produced, and now they're stuck in container ships, and China's still kind of closed with their COVID controls and their attempts to COVID control, that kind of thing. So all of that happening at once, now we actually have real inflation. And so mortgage rates go up because bond prices fall, right? So there's a seesaw between bond prices and interest rates, and the mortgage rates are tied to the 10-year treasury bond. And so inflation causes that to go up because investors are basically saying, if inflation is more than what I can get paid for the bond, why should I hold the bond? So the bonds get sold, the prices go down, the yields go up. And so I just think we're in a different type of period than we were before. And I'm not sure if I answered your question.
You're looking at the old dude going, hey, do you remember what you asked? I'm like, no.
Yeah. Whatever the question was, I answered.
I think it was a really good answer to whatever I asked you. Yeah, I don't know what I was talking about. Well, and that's the thing that I think a lot of people get confused by is they relate back to 2008. And that's a question we hear a lot. Like, are we in the same circumstances that we were back then? And we try to answer them with all the details and the facts about, no, this is a completely different situation. So maybe if you can expand on that a little bit, like what led us into that, the great financial crisis you're talking about, and compare that to where we're at now. And are we, looking at anything similar to 2007, 2008.
How much time do we have on the show?
They made a movie about this too. Like we could probably make a movie.
Several movies about this. There's a lot of good ones. I mean, The Big Short is a great one on this that really details this well. There are several movies that came out of that time period that illustrates it. I would say what caused it, by and large, and this is going to be an incomplete answer because there's a lot of things in the markets that caused this, but the biggest things were the money was easy, and not because rates were low, but because it was easy to get a loan.
Blaming the mortgage guy again. Right?
I'm just saying. Look, I was there. I was a mortgage guy in the early 2000s, so I was there. I participated, right? It was easy to get a lot of money. It was easy to refinance. And what happened, especially in the subprime markets, which really is where this all kind of broke apart, is you had 95% loan to value loans, 7% interest rates, 2 or 3 year adjustable rate periods. And so, you got a fixed rate for the first 2 or 3 years. What do we call those? 228s or 327s, right? That's what they were. And so for the first 2 years or maybe 3 years, you had a fixed rate. And then after that, you were subject to the adjustments. And so we basically had that happening. At the same time, we had investors in the secondary market, which is where the mortgage-backed securities are bought and sold, they were packaging these loans into what are called tranches, which are just baskets of a lot of loans. And what the investors saw was the good paper on top. They didn't see the rotting apples below. And so when those tranches started to get exposed and the defaults started to increase, right? And this was people who had a second and a third home because everybody was flipping and they were trying to rent, everybody was a landlord or whatever. I wasn't, but knock on something. But that's what happened. Those houses went first and then the primary residences went after that. And that started to blow up the tranches. Meanwhile, we had some insurers like AIG was the biggest probably participant in this, where they were writing guarantees on those papers. They were called credit default swaps. And for, the ease of time, it basically meant that they would ensure that this bunch of loans would not default. And if they did, then you had an insurance on it that, just like you would insure anything else, right? If this negative thing happens, we'll cover your cost. And so that all kind of blew up at the same time. And so that's what led us largely into the last one. By the time that started to happen, it was too big. It was too endemic in the financial markets, or it might have been pandemic because we're familiar with that word. It was really bad in the financial markets. And so that's what caused the crash. And so then the Fed was behind the curve on that because we basically went from a discount rate of somewhere in the 5-6% range. They had to go to zero from there to there. And it took a long time for the economy to recover. It took a couple of years.
And one of the things too, that the differences that you hadn't touched on yet is the housing supply.
Yeah.
It's just vastly different than where we're at today. People could get loans. We used to say if you could fog a mirror, you can get a loan.
Right.
Literally.
Your dog too, probably.
Yeah. You work at McDonald's and you can state I make $150,000 a year, but I have a 560 credit score and I'm going to go buy an investment property with no money down.
Right.
Like it was that bad to where anybody could get a loan. So there was speculation, but there was houses, like tons of houses being built by home builders. So there was a ton of supply. And then all the things that you talked about, came to pass. People started having these interest rate changes come, and then they were stuck in it because they had a prepayment penalty, or then they couldn't afford the new payments.
Right.
And so it all fell apart. But there was so many houses that were being built at that time. And then contrast that to where we're at today. There's not enough houses at all.
Yeah.
And then you can kind of talk about the financial aspect, how the difference is from that time to where we are today.
Yeah, there were parts of the country. It happened here in Phoenix, Miami-Dade County, some parts in Texas, and so you had this glut of homes being built. And when that stopped, a lot of these builders went out of business, realtors went out of business, mortgage people went out of business, and so in some communities you had literally like half of a standing structure, or you had houses that were not moved into, and so a lot of those ended up vandalized and condemned, and so they were completely uninhabitable. And so that happened, or maybe you were able to get a deal from a fire sale, in a housing community or something. But those things were few and far between. So that all 07, 08, 09, right? The financial crisis started in the summer of 07. And a lot of people think it started in 08. It started around July, August of 07, and then cascaded from there. We didn't start really building houses again, like on a big scale, until like 2012, 2013 in a lot of places in the country. And so during that time, we had a lot of things happen. We get generational, right? The boomers were going to hold their house and they were going to pay it off, and they were, because they've seen this before, so they're never going to fall in that trap. And millennials were never going to be homeowners, right? We heard that they were never going to be homeowners. They were never going to invest in the stock market because of what happened in 2007, 2008, 2009. Yeah. And so that changed psychographically and demographically. And so what happened in a lot of communities is they started rebuilding, but they were rebuilding higher income attained properties, right? So luxury condos, luxury apartments, bigger homes, that kind of thing. And so a lot of people get priced out of the ability to have a good home or the type of home that they want. So for a long time, those people, the millennials, didn't buy, the boomers didn't move. And that changed. All of that changed. And that's where we are now. And part of that is because, we had a pretty good economy from about, 2014 until right up into the pandemic, and things were pretty strong. And then when we flushed a whole bunch of money into the market, and it was easy to get PPP loans, and I don't know how many rounds of stimulus did we get, like 5 or 6 or something like that. And we had, moratorium on evictions and foreclosures. And so I think that we created another situation where what we allowed then we're paying for now.
Yeah, that's the thing I think that some people miss in all this is when they hear about inflation and they hear about the Fed, they hear about the Fed raising rates, and they think that the Fed, while the Fed has a role in inflation, of course, but it's not a direct correlation to increasing rates is causing things to be more expensive and causing inflation. I mean, inflation led up to this. The Fed was behind the 8 ball in terms of their reaction or their preparation for it. And can you kind of expand a little bit on the point about the Fed raising rates and not having a direct impact on mortgage rates? Because that's something that we talk about a lot with people.
So I guess an easy way to illustrate it is, let's say I'm the Dale Bank and you're the Bryan Bank, right? And we're the presidents of these banks. And we both have been loaning money out. You actually are getting a little bit smarter and a little bit ahead of the curve on this than I am, right? Because I'm still like, I
don't know about that.
No. Let me give you be the smarter bank president.
All right, I'll try that.
We're Dale Bank is still lending money. Bryan's bank is like, I think we need to keep some, requirements on hand. The Fed is talking about interest rates, so let's lend a little bit less. So the Fed, we've been at 0 to 25%. Now that's important because what the Fed cannot do is mandate a specific percentage that banks charge each other on an overnight basis, right? That's what's called the Fed funds rate. So when the Fed raises or lowers rates, they're raising and lowering the Fed funds rate. It's a monetary policy tool. If they raise rates, it restricts, it brings, the economy tighter. If they lower them, it runs it hotter in general sense. So the Fed has a range from 0 to 25%, and we've been there since March of 2020. March of 2022, the Fed meets, they decide that they're going to raise rates, right? So they gave us a 25 basis points adjustment. So we went from a 0 to 25 basis points to 25 to 50, right? So that was the target range. Now the banks can decide where in that range they charge one another for the reserve requirements or to borrow from each other. And usually it tends to be kind of the middle of the range, right? That tends to be what the banks do. So Dale Bank's lending money, Bryan Bank is kind of hedging a little bit. The Fed raises rates. So what that means is that I have a reserve requirement because of Dodd-Frank and some of the other banking legislations that came out. You have a reserve requirement, it's the same. And so I might be under my reserve requirement for the night, and I call you and I say, hey, I need, X number of dollars to borrow so I can meet my reserve requirements. And you tell me that you have it on hand and you're happy to lend to me, and it's going to cost me, let's say, before the Fed adjusted rates, it would cost me 12 basis points to borrow that money overnight. No problem. I borrow the money. I pay you the interest the next day, right? When the contract expires, the money goes back to your bank. You get your interest payment. Sounds fair, right? Now, when the Fed continues to raise rates, then it costs more money for Dale Bank to borrow from Bryan Bank to meet the reserve requirements. And so as that continues to happen, then what I do and what you do is we stop lending as much money, and at the same time, we increase the rates that it costs to borrow. Some of that is controlled by us as the bank presidents because we'll have whatever the interest rate is, be it whatever our mortgage rates are. A lot of the other things that we lend on, car rates and credit cards, those are tied to the U.S. prime rate. But we can put a spread on top of that, and that's what we charge our consumers, which is how consumers are able to do interest rate shopping because we might have a 4% prime rate and my multiplier might be 2%, yours might be 1.75, right? So that's how banks compete. That's how consumers rate shop. And so as we continue to increase our rates because we have payroll and we have to keep the bank building in good standing and, you know, all those things, that's what happens. So that's how interest rates move based on what the Fed does. It happens more at the banking and the institution level than the Fed going, let's move mortgage interest rates this and let's move car rates this. It just doesn't work that way.
Well, and that's where it's your illustration there was really good because it clearly does not include any attachment to mortgages. And
right.
So that's where, you know, we hear from people a lot of times, oh, I heard the Fed raised rates, you know, 0.5%. And then we've got to back up and say, well, yes, they did, but that didn't affect your mortgage rate. Sometimes we actually see an opposite effect. Mm-hmm. And we end up seeing the opposite effect sometimes because, like you mentioned before, inflation is the reason that these rates went up. Can you kind of explain why that might actually, as the Fed is raising rates over the next few months, as they've kind of targeted, why that might cause interest rates to go down on mortgages?
So mortgages are more commonly tied to the 10-year Treasury bond. So as the 10-year Treasury bond yield goes, so goes mortgage rates in a general sense. And so there are some other factors in there, but that's generally what we would kind of peg. If you want to know what the 30-year mortgage rate's doing, you can probably get a pretty good idea based on where the 10-year yield is. And so as a mortgage professional, I imagine there's times where, you know, you get your rate sheet at the start of the day, the 10-year yield might move around. You might get the ability to, you know, move off the rate sheet and lock a loan at a lower rate, you know, later in the day than you could at the beginning of the day. I imagine that happens from time to time.
Yep.
And so
a lot the last few months.
I bet.
And not always lower.
Not always lower. So the reason that happens and the reason inflation is a driver for that is if I buy a bond and the yield on that bond is, say, 4%. And at the time that I buy that bond, that's yielding me 4%. So if I buy a $1,000 bond, it's going to pay me $40 a year, right? That's the way that works. So that's my coupon. If inflation at the time that I buy that 4% bond is 3%, then my real rate of return is 1%, right?
Yep.
Because when you buy a bond, you're basically buying a set of future cash flows, and those have a value. When inflation goes to 4% and I still have that bond at 4%, then my real rate of return is 0.
Yeah.
And so when inflation goes to 7 and I still hold that 4% bond, I want to sell it because I've got a now negative yielding bond in real terms. If you're an investor and you look at your bond returns this year, they're really not that far off from your stock returns this year, which neither look that great. And so a lot of that is the cause of inflation, because why would I continue to hold a bond or a stock that has such a negative return when I could take the cash and go buy something else? The challenge right now is that because of all those things, there's not a whole lot attractive out there to buy, and you're losing real terms value of your cash because the inflation is high. So, you know, the dollar is probably, like, the dollar in your hand is worth, you know, maybe 7-8% less than it actually really says on the paper.
So you want a house, but you keep getting beat out by all the cash buyers and institutional investors. So what do? Well, you need to call us at the Cardenas team at Finance of America Mortgage. We can turn you into a cash buyer even if you need a mortgage, so you can beat out the competition and get the home that you want. Visit us at www.thecardenasteam.com or call us at 480-331-4684 to schedule a free consultation. The Cardenas team, we treat you like family.
So when everything is seeming to not look great as an investment right now, are there things that are more solid investments at a time like we're at right now?
Yeah, I'm a big believer in, as an investment advisor, financial planner, all of that. Those of us who do good work do investment advice that's tied to the specific objectives that are within the financial plan, and that's based on what the client decides is most important to them, and with the help of the plan, we work toward those objectives. The investments feed that goal. So I'm a big believer in when we set an investment strategy, if we're doing it from a strategic basis and we like what we bought because we've looked at the valuations, we know what we own, we know what's inside of a mutual fund or an ETF, or if we're buying individual stocks, we know what those companies are. If we're buying quality at the start, when the market does what it's doing now, everything's going to be pulled down regardless. You have great companies that just at the whim of the market or because of sentiment just get completely chopped. Because there's something in the earnings report or whatever that the market doesn't like. And so you get enough of those in a mutual fund or an ETF, everything's going to go down, right? As the stocks do and as the bonds do. So if we like it when we buy it and we know what's there, I generally am a proponent of holding on to what we have when everything goes down, because if we think about it, that's really not all that different than a really good Black Friday sale. Right? Everything's 10, 15, 20% off. If you have cash that you're sitting on, let's buy more while it's on sale, because as the market recovers, and I'm not smart enough to be able to tell you when that's going to happen, but at some point it will. And historically, that statement is true. And as it does, as you're buying more, it actually tends to benefit you longer term from a long-term rate of return. So that's what I would recommend. A lot of what we saw over the past 2 years has been people just buying things because it was the next thing to go to the moon. And a lot of things that went to the moon fell back to earth pretty hard over the past 6 months or so.
My little crypto stuff is kind of taking a beating too.
Oh yeah, no, mine, no. So, and that's everything in the portfolio. So over the past 2 years, it was not all that difficult to set up a dartboard, throw a dart, and pick your stocks. We had a well-known hedge fund manager, I'm not going to mention any names, who was buying stocks based on the letters he pulled out of a Scrabble bag, and if it matched a ticker that's in the market, that's what they bought. It was insane, right? What we saw over the past 2 years was just a high level of insanity, right? The whole thing with the GameStop and AMC and that whole game, that was just nuts. And so those aren't the kinds of things that we do when we're doing strategic asset management. If we're trading and if we're gambling, right, which I'm still trying to convince people that I know very well that what I do is not professional gambling or smart gambling, right? If we're buying from a strategy and we know what it looks like on a back test, we never know what it's going to do in the future, but we have pretty good indicators. And if we buy quality first, I'm a big fan of holding on to it.
What do you see happening with the real estate market over the next few years?
Yeah, I think I'm a little, not an expert in real estate, and I wouldn't pretend to be, but my guess is that because we will see mortgage rates probably sustain at a higher level for a period of time, and there's a lot of things that need to happen for mortgage rates to come back down at some point. Again, not directly related to what the Fed does. But if mortgage rates remain elevated from recent lows, I think the real estate market will probably cool a little bit. And some of the realtors that I talk to, that's already started to happen. Some of the other mortgage professionals that I know, they've already seen a slowdown in their pipelines. And so I think we'll probably still have home prices that will remain kind of flat, still high. I think it would take a major recessionary period for home prices to just completely fall much lower than they are now. And they would have to fall pretty big. But I think over time, what we see is we see home prices come up and they stay elevated. They may go back down, but they kind of, just like the stock market, they revert back to whatever that new mean is over time. And so I just think you'll continue to see a wave that probably goes higher over the long period of time, but we might kind of plateau for a bit.
Yeah, I think the circumstances that we have now being so different than what everyone has experienced before in 2008, and everyone's afraid of happening now is just, it's so different. Like you can't get a loan by fog and a mirror anymore. Like you actually have to qualify. You have to prove that you can repay the loan. So the availability of the money that people would use to speculate on real estate is not there. There's some speculation still going on, but it's generally from people with lots of cash, or a lot of skin in the game if they are borrowing some money.
Right, and that's the thing. Even leading up over the past 10 years, it has been more difficult than it was in the prior 10 years to get financing and to qualify for financing. So, I think that's probably the most helpful thing that we have in this whole situation is that it hasn't been as easy to qualify, even though the rates have been great. But you're still not able to take 100 or 125% of your equity and cash out.
That was happening too.
Right.
Yeah, and the other thing too that's really different is just the number of homes that are available on the market. We've seen a big uptick in the last month in the level of homes that are available. I think what was a 43% increase over the last 4 weeks, I believe. But the level that we're at is still like 50 to 70% below what a normal balanced market is at. So I think, we're still going to have that supply and demand imbalance. Demand will cool a little bit with higher rates, of course, but it was so out of whack, and home builders are so far behind in terms of building new supply that it'll be tough to see anything close to what we had happen before happened in this market. I think real estate looks pretty strong to not be out of control like it has been the last couple of years. 20 to 30% appreciation is crazy and not sustainable. But I think if we get back to the norm, 4 to 5%, I think a lot of people feel like that's something that's feasible, that's sustainable. That's kind of what our average is. And we're starting to see a lot of people that tried to really capitalize it and are still having their list prices pretty high. They're having to come back off of it. And so I think that's probably what you're hearing for a lot of people in the industry. It's
taking longer to sell houses. I mean, we had, I think we were down to, less than 24 hours on average, right? From listing to contract.
Some stuff is crazy. Yeah.
And so now we're getting back to the range where sometimes it's taking 20, 30, 45 days to sell a house. Which is great because in theory, you stretch that out enough and we end up with a home supply. What is it? Realtors typically want to see something like 4 to 6 months of home supply to consider that to be a healthy market. And, I know going into 2020, we were down to about 3 months. Fast forward a year, we were down to, 2 weeks. And so I actually think it's good that it's taking longer for homes to go from to go from listing to under contract, because that probably means that we're having to do some price adjustments, and that's good for the consumer. So it's still very much a seller's market in real estate, and at some point we may get a little bit of a buyer's market, but I think it's going to be some time before that fully shifts.
So what do you think would be the biggest factor that could change, or that whether it's government or supply chains or whatever, that would start to ease the inflation pressures that people are feeling in everyday purchases, whether it's gas or groceries, what have you?
Yeah, I think it's difficult to answer because so much of what we experience is polarizing. So a little bit of it is, who are we listening to? Where are we getting our information? That's part of it, because the bias feeds the activity in a lot of cases. So some of it is related to that. It's just the basics of who is saying what and what do we believe, and are we able to do something, right? So that's part of it. Another part of it's going to be, we still have a supply chain that's not healthy, and there's a lot of debate now that maybe the globalism experiment has failed, and all it took was a little tiny pandemic, right, to shut it all down. And so maybe, just maybe, that is that's a great case for just bringing everything more domestic and not relying on goods and services from, Asia and other parts of the world. And we still have things sitting in containers, and it's still not as easy to get the basic things that we want to get. I can go on Amazon and get most of what I want, but I can't walk into my local store and get the same thing on Amazon, right?
Yeah.
And so that's a bit of a challenge. And we have to really be mindful of that, because if we get to a point where the local shop cannot meet the demand of the consumer, we'll start to lose some of those. And we did lose some of those, through the pandemic. So the supply chain is going to be part of it. Monetary policy is going to be part of it. The Fed, I think they have a very difficult road ahead of them, as far as how they move interest rates, how fast they move interest rates, because again, that weighs on the psychology of the market. A lot of people will look to the stock market and have that be an indicator of the strength of the economy, but the economy and the market, those are disconnected things. They're not the same thing. And so there's an awful lot of psychology that's built into these things. So if we continue to see the Dow Jones sell off 1,000 points a day, which, by the way, we're talking about 30 stocks here, right? We're not talking about the market. So just don't look at the Dow Jones. Just say it. It's only 30 companies, right? We need to know that. A lot of people don't know that. It's only 30 companies. But if we look at something bigger like the S&P 500 or the Russell 2000 or whatever it is, if we continue to see stocks sell, then we go, oh man, this economy is getting really bad. Look at the stock market. And, there's a lot wrong with that statement. So that's a part of it. But if the Fed can stick the monetary policy and we don't get loopy things out of Congress, right? We're in a midterm. This is midterm year.
This is crazy time.
It's crazy time. And there's all kinds of things that will happen. I mean, they're talking about, student loan forgiveness, and they're putting all kinds of things on the chopping block, and the platforms are getting more and more off to the extreme, because it tends to be that's where most people exist. Although I don't think that's true, but they have the loudest microphones.
I think the loudest people exist on the extremes.
On the extremes. And so we see politicians kind of pandering to that. And so that's definitely a part of it. And so I think a lot of it really revolves around how money gets used, what it costs us to use that money, our relationship to money, what we think about money and what we see in the world. There's a lot of it that really is up to us. Now, we can't, and I mean, anyone can try this, but I don't think a national protest at the gas pump is going to bring gas prices down, right? Because they know, I mean, we all know, like, we'll protest today, but tomorrow I still got to go to work. So I got to put the gas thing in there, and we can't buy enough Teslas, right? Because, that actually uses an awful lot of energy to charge that car. And so there's no perfect answer to this, but it will just take time. I think time is the ultimate pill, the magic pill, if you will. It's not quick. And we didn't get into this overnight. We're not going to get out of it quickly either.
Since you're a professional gambler, what are our chances of ending up in a recession?
That's a really good question. And I think that's the big question that everybody's asking. I think I heard a stat today that in the published news media last year, there was something like 80,000 or so articles published on inflation last week. And so everybody's talking about it. I think, we're still at a point where we have, even though we have a lot of job openings out there, right? A lot of people are looking for workers and can't find them. Unemployment is still relatively low. And we would look at it and say, we're almost at full employment, but we have a shortage of people. And so, so that's happening there. So I think, if we see conditions where, we have wage growth that gets exceeded by inflation, and if that continues to happen, because at some point your employers can't keep paying you more to keep up with the cost of living. So if those things start to break down, we lose workers. The gig economy has been, a blessing in disguise. It's kind of like the devil, in a lot of cases, because that's part of why people aren't going back to work, because if you can make $1,000 a week, or delivering food, why would you stand over a counter and make food for $500 a week, right? So there's a lot of that kind of thing happening. And I don't know if that's exactly true across the board, but there are some instances where that's the case. So if we lose employment, if we lose wage growth, if inflation persists, if the Fed pushes that higher by going too fast with raising rates, they're going to overshoot their targets. Historically, they do anyway. And so we're probably going to see that happen. And then at some point, maybe they'll back down or they'll hold off on raising rates in another cycle. So, but if those things turn, I think we could see some sort of an inflation. From what I've read and from what I hear from people who are way smarter than me, if we get an inflation, it probably would be relatively mild and short-lived. It would be nothing like what we saw in 2008 and 2009, that time period, but it's always possible. And fortunately, right now, we don't have the setup that we did going into that last period. There's a lot of things that are still good, and we had a pandemic, and that caused a lot of issues everywhere.
Yeah, that was slightly different than 2007.
Big time. Yeah, big time.
Yeah, and I think the thing that when we're talking about these things and recession, people hear that and they hear the negative things that happen in a recession, like job loss and wages going down, things like that. Mm-hmm. What are some of the things that happen in a recessionary period with interest rates and housing historically? So
historically, in a recession, we tend to see interest rates go up. And again, that goes back to the activity on the yields. Right now, we're at a point where we're seeing rates go up at the same time that we're seeing inflation go up. And that doesn't always happen. Usually one kind of precedes the other. Right now, it was inflation shot up, and so the Fed's trying to calm that. So if you go back to the recession that we had in the late 70s, that started back in 74, 75, 76, kind of right in that period. And the Fed didn't actually attack it until the early 80s. And that's where we saw then Fed Chair Paul Volcker really throw the hammer down on interest rates, right? And I mean, the Fed rates went way high, and that was only that they could break inflation, which at that point turned into stagflation, which is worse, right? Because then, everything's out of balance. We don't have that setup. We don't have the setup that we had, here. It's a little bit different. So
now let me be clear, though. You're talking about rates like the Fed funds rate.
And even borrowing rates. Yeah, borrowing rates. Because as the Fed, as we talked earlier, as the Fed moves the rates, that tends to increase borrowing rates because, that all things kind of float higher. It's an influencer. It's not a direct one-to-one. But also when we get inflation and we get kind of recessionary periods, we do tend to see bond prices fall. And that's because of the fear factor, right? We see stocks fall, we see bond prices fall. When bond prices fall, yields go up. And when yields go up, it does influence mortgage rates and things like that. So, and that can be a negative for the economy as well. And so, we have a lot of things happening at once.
So do we have the right people at the helm to guide us through this? Good thing this is an opinion-based show.
Yeah, again, everything gets polarizing, right? I will tell you that in my opinion, even though I said earlier that in my opinion, I think the Fed's waited too long to raise rates this time. I think Jay Powell has done an exceptional job trying to manage this since March of 2020. The Fed took immediate action. They took swift action. They actually did more faster than any Fed had before to stave off a crisis or to try to control what was happening. They did things that even, Ben Bernanke in 2007 and 2008 didn't do. The Fed went in and they were directly participating in buying securities in the open market, and that hadn't been done that way before. And so I think that they did exceptional things to make what happened, and then Congress right behind them stepped in and provided an awful lot of liquidity for the consumer at the same time. And so that was good. It had some negative downturn effects, which is often what we're seeing right now. As far as who we have in Congress and in the White House, I think that whether you're in the middle, whatever that is anymore, or you're on the right or the left or the extremes of those, I don't think you'll have very many people who will say, I think Congress is doing a great job, and they've been doing a great job. Nobody's happy with Congress, but we continue to elect the same people to go back there, so we get what we get.
We're super
right?
smart people, aren't we?
Super smart people, right? They're doing a bad job, but I don't know this other person, so I'm just going to vote for the name I know.
Yeah.
And off we go. So I personally, I don't think it should be celebrated that we have people there for 20 and 30 years holding those seats. I know that it takes a long time to build relationships, especially for international diplomacy. I get that it takes time for, contracts to move and for things to happen. But I think that we probably should exercise term limits at some point, and whatever that is. But if we did, we would probably get a better sampling of people who go there, knowing that even if you get reelected, it doesn't matter because the most that you can serve is this. I mean, we only let a president serve 8 years. We could probably do the same in some form with Congress and Senate. And there's a chance that maybe we'll get more of our best and brightest that will go serve and then go back in the community and have a good impact. So
it's an interesting concept that we started with way back when, is that was the idea for people who were, just John Q. Public going and serving, as an elected official for a short period of time and then go back to their regular life.
Yep.
And somehow this morphed into, a career where people get enriched by virtue of the fact that they're in Congress or they're in the Senate or, wherever that they are currently residing. So I think, turnover would be really helpful, and getting some new perspective, new ideas, and some of those relationships that you talk about are important to forge to get things done, but also some of the relationships that get forged are also not very helpful to the public. Mm-hmm. Definitely beneficial to the people in those relationships. And, I think those are generally not very helpful for the general public out there. So interesting stuff. So kind of to tie things up and bring it back to real estate, what would you say is something that you could advise people, whether they're thinking about buying or selling a home, about where we're at right now? Is it something that they should just keep doing what they're doing? Should they hold off and wait? Like, what advice would you give to somebody?
Yeah, I think it depends on your situation, right? So I would go back to, if you're looking at buying a home, let's get really clear on the type. Why are you buying a home? What's important to you about that decision? B, what type of home? C, what are the high and low bounds that you'd be willing to spend for this? And then D, as a planner, of course, how does that fit into your cash flow, right? Is it going to stretch you? Is it going to prevent you from accomplishing some other things that are important? Or is it going to fit? And that really is an important consideration because, again, as a planner, if we're going through what your objectives are and what you define as most important to you, if you tell me that you want to buy a house, that's a goal or an objective. And you tell me that, you want to send Timmy and Susie to college and you want to pay for half of it because you want them to have some skin in the game. Well, that's an objective. And if you, want to save in your 401k or whatever, right? So you have these things. If your home decision violates those other things, then it's my job to ask you how we need to shift the priorities, right? Because if it's going to cost you more to have this house and it means that you won't be able to fund half of Timmy and Susie's college, maybe only 30%, well, let's have a conversation about that. Let's understand how important that house is at this time. There are certainly situations where, I have several clients who are involved with real estate transactions, and rates have gone up while they're in the middle of that transaction. The decisions for what they were going to do, what home they were going to buy, how much they were going to be able to realistically manage in their cash flow has changed. And so for some people, the difference between I'm buying a $400,000 house at 3.25% interest to I'm now buying a $4,000 house at 5.5% interest, that's a real calculation. That's several $100s more in a mortgage payment for some people that it may not work. And so what I'd recommend is if you're going to buy a house, you're probably going to buy a house. Just be very clear on the reasons that you're going to do that, and then be very clear realistically on how long you're going to live there. Because there may be some times where you're going to buy a house, but you know that in 5 years your life's going to change because Timmy goes to college, and so you need one less bedroom maybe, or you become an empty nesters, or somebody gets married, or you're going to relocate, that you work the type of job where it's very possible that you could end up in Houston, in 5 years. Or you just go, yeah, I don't know. I just get tired of this thing, and I'll probably just have it for 5 years and then I'll sell it and I'll do something else. If that's the case, maybe a 30-year mortgage rate isn't for you. Maybe there's some other kind of financing plan that makes more sense for your profile. So it would become important to work with a good financial advisor, a good financial mortgage lender who understands more than just, I can get you this rate, or you can afford this. Let's actually do the work to understand what they value, why they value that, what's important about that decision, and help them do the right thing.
Cool. So it's all about what are your goals and what's important to you. And that's kind of where we always take that approach. So I love to hear that that's the same thing that you do. Well, I just want to say thank you for joining us today. I think this has been a very educational conversation. I think there's a lot of things that people don't understand that you definitely shed some light on and help them understand. So I want to say thank you. And then if you could just tell us your contact information if someone wants to reach out to you and see if you can help them with their financial plans.
Yeah, thank you. And, again, very difficult to tie all these up concisely in a short period of time. So more to come. If you ever want to sit down for like 2 or 3 hours, we could probably flesh a lot of this out. But okay, so again, Dale Shafer with Life Moves Wealth Management. And you can find me online at www.lifemoveswealth.com. Local phone number, do I get phone number, email? So local phone number 602-223-1801. And you can reach me at dale.shafer, SHAFER, at lifemoveswealth.com. I'm also on Twitter and LinkedIn and Facebook and all those fun places, and under Life Moves Wealth, not that hard to find.
And you might find him hiking a little bit too, or biking.
A little bit,
like that.
Yeah.
All right. Thank you very much, Dale, for joining us. Appreciate it. And thank you guys for joining us, and look forward to seeing you on the next episode.
Thanks for joining us, and please remember to go and subscribe, like, share, all that cool stuff to help us grow, and come back tomorrow to listen to our next episode. Until then, go out and live life uncensored.
Thanks for listening to the Uncensored Real Estate Podcast. Don't forget to help us out and subscribe. Follow and give us a 5-star rating on your favorite podcast platform. And check us out on YouTube for the full video podcast. If you want more information on any of the topics discussed on today's episode, email us at uncensoredrealestatepodcast@gmail.com or give the Cardenas Mortgage Team a call at 480-331-4684.